Hello everyone, welcome back to Fundrise Finance. It'll be an understatement if I can say that the market so far this year has been volatile. In the first 6 months of the year, we have seen the stock market behave the worst in the last 50 years. But since mid-June till now, we have seen the markets rebound by more than 12%. Even though the market has been trending downwards for the most part of the year, dividend investors who have chosen good, smart stocks into their portfolio have been impacted less relatively. Among all this volatility, good dividend paying companies have continued to raise their dividends. So, irrespective whether the market is up or down, as long as you hold the stock into your portfolio, you will get paid dividends. In today's video, we will see 10 such companies who have recently announced dividend increases, and we'll see which of these are undervalued or overvalued because that matters a lot. A good, smart investor should always look to it that he's not overpaying for that particular stock. So, without any further delay, let's get into the video. The first stock on our list is Kellogg Company, ticker symbol K. Kellogg's is a very well known consumer staples company. We can instantly recognize Kellogg's from its cereal brands and snack brands like Cheez-It, Fruit Loops, Eggo, Grahams Cracker, the ever so popular Cornflakes, Kashi brand, as well as Raisin brand. Year-to-date, Kellogg's has returned a positive return of more than 15%, which is much better than the broader market, as do many of the other consumer staple companies. The last 1 year, we see a return of almost 18%. The last 5 years, almost 11% returns. Kellogg's has a market cap of $24.98 billion and currently yields 3.14%, with a forward PE of 18.18. From dividends perspective, Kellogg's has just announced a dividend raise of 2%. I know that's not a lot. It has an ex-dividend date of August 31st. So whoever owns the shares of Kellogg's by August 31st, they'll be paid on September 15th. Historically, Kellogg's has been raising its dividend for the last 17 years. The 5-year dividend growth rate of 2.21%. So the recent dividend raise of 2% is in line with its 5-year dividend growth rate. The payout ratio is 55.77%. Tracker Dividends gives Kellogg's a dividend score of 74 and considers it undervalued by 13.47% with a fair value estimate of $85.43. Morningstar considers Kellogg's a 4-star stock with a fair value of $82. But as for my calculations, which considers current and historical yields, I found Kellogg to be overvalued by 1.57% with a fair value of $72.76. I personally would not like to have this company in my portfolio. Though it yields currently more than 3%, the dividend growth rate is very, very low, just 2%. The current high inflation environment that we're living in, these dividends will just get eaten away. So I would rather stay from it. The next stock on our list is Bank of America, ticker symbol BAC. Bank of America is from the financial sector and is one of the leading banks in our country. Year to date, Bank of America has fallen 27%. The last 1 year, it has fallen just over 11%. The last 5 years, it has returned just over 37%. Bank of America currently has a market cap of $271.67 billion and currently yields 2.48% with a forward PE of 10.47. Recently, Bank of America had raised its dividend by 5%. So for all the stockholders by September 1st, they'll be paid the dividend on September 30th. Historically speaking, Seeking Alpha shows Bank of America raising the dividend consecutively for just last 1 year. So I don't think that is correct. If you look at the dividend payment history for Bank of America, we can see from 2019 Q2 onwards, the 18-cent dividend payment got stagnated all the way till 2021 Q2, and then the increase came into picture for 21 cents. So maybe because the 18 cents dividend was stagnated across 1 year, Seeking Alpha considers Bank of America raising its dividend from 2021 only. That's why it's showing 1 year as the consecutive increase. There's a 5-year growth rate of 22.87%. So the recent dividend raise of 5% falls well short of the 5-year dividend growth rate. That's a payout ratio of 26.25%. Tracker Dividends gives Bank of America a dividend score of 75 and considers it undervalued by 18.35%, the fair value estimate of $41.41. Morningstar considers Bank of America a 4-star stock with a fair value of $40. As for my calculations, I found Bank of America to be undervalued by 17.85% with a fair value of $39.85. I do own a small portion of Bank of America in my M1 Finance portfolio, and at current valuations, I do intend to add to the current positions. The next stock on our list is PPG Industries, ticker symbol PPG. PPG is from the material sector that manufactures and distributes paints and other coatings worldwide. Year-to-date, PPG Industries has fallen more than 24%. In the last 1 year, it has fallen almost 21%. In the last 5 years, it has returned almost 22%. Recently, PPG had raised its dividend by 5%. So, for all the shareholders of PPG by August 9th, the dividend will be paid on September 10th. Historically speaking, PPG has been raising its dividends for the last 49 years. That makes it part of the exclusive group of companies called Dividend Aristocrats, which belong to the S&P 500 and have been raising dividends consecutively for at least 25 years. In this case, PPG is almost double of that. One more year, and PPG will go into another exclusive group that's called Dividend Kings, who have been raising their dividend for more than 50 years. The 5-year dividend growth rate is 8.08%. So the recent dividend of 5% increase is less than the 5-year dividend growth rate. The payout ratio is 38.5%. Tracker Dividends gives PPG Industries a dividend score of 78 and considers it undervalued by 2.47%, with a fair value estimate of $132.57. Morningstar considers PPG a two-star stock with a fair value of $113. As for my calculations, I found PPG to be undervalued by just 0.69%, the fair value of $130.18. I do own PPG Industries in my Fidelity portfolio, though it's a very small portion. At current valuations, I don't intend to add to it. Maybe if the stock falls much further than the current levels, I'll have a relook at it. The next stock on our list is American States Water Company, ticker symbol AWR. American States Water Company, as the name suggests, is from the utility sector and provides water and electric services. Year-to-date, American States Water Company has fallen almost 15%. In the last 1 year, it has fallen just over percent. Last 5 years, though, it has returned an impressive almost 80%. It has a market cap of $3.22 billion and currently yields 1.67% at a forward PE of 33.48. Recently, American States Water had raised its dividend by 9%. So, for all the shareholders of this company by August 12th, the dividends will be paid by September 1st. Historically speaking, American States Water Company has been raising its dividend for the last 19 years at a 5-year growth rate of just 9%. So the recent dividend raise of 9% matches its 5-year dividend growth rate. Currently has a payout ratio of 58.13%. Track Your Dividends gives American States Water Company a very good dividend score of 89, but considers it overvalued by 2.32% with a fair value estimate of $85.15. Morningstar considers American Water Company a three-star stock with a fair value of $85.57. As for my calculations, I found AWR to be undervalued by 6.05% with a fair value of $92.44. I do own a small portion of the stock in my Fidelity portfolio. I do not intend to add at current levels. Maybe if the company's stock falls by more than like 5 or 10%, I'll have a relook at it. The next stock on our list is Charles Schwab Corporation, ticker symbol SCHW. Charles Schwab is from the financial sector and provides wealth and asset management services. Year to date, Charles Schwab has fallen almost 20%. The last 1 year, it has returned a positive 1.5%. The last 5 years, it has returned just almost 60%. Charles Schwab has a market cap of $130.94 billion and currently yields 1.1%, with a forward PE of 17.63. Recently, Charles Schwab had raised its dividend by 10% and also authorized a 15 billion stock buyback. All the shareholders of this company by August 11th will be paid their dividend on August 26th. Historically speaking, Charles Schwab has been raising its dividend for the last 7 years at a 5-year dividend growth rate of 20.43%. So the recent dividend raise of 10% falls short of the 5-year dividend growth rate. There's a payout ratio of 22.09%. Track Your Dividends gives Charles Schwab a dividend score of 60 and considers it overvalued by 7.98% with a fair value estimate of $63.54. Morningstar considers Charles Schwab a 4-star stock with a fair value of $84. As for my estimate, I found Charles Schwab to be undervalued by 9.82% with a fair value of $75.83. The next stock on our list is Mondelez International, ticker symbol MDLZ. Mondelez is from the consumer staple sector that manufactures and distributes snacks and beverages worldwide. We may be very well aware of the brands that Mondelez owns, like Belvita, Cadbury, Halls, Oreo, Philadelphia Cheese, Tang, and Toblerone. Year to date, Mondelez has returned a negative 1.5%. In the last 1 year, it has returned just over 2%. The last 5 years, Mondelez has returned over 47%. It has a market cap of $87.77 billion and currently yields 2.19% at a forward PE of 22.28. Recently, Mondelez had raised its dividend by 10%. So, for all the shareholders of Mondelez by September 29th, the dividends will be paid on October 14th. Historically speaking, Mondelez has been raising its dividends for the last 8 years at a 5-year dividend growth rate of 13%. So the recent 10% dividend raise falls short of the 5-year average growth rate. It has a payout ratio of 47.78%. Trackio Dividends gives Mondelez a dividend score of 75, but considers it overvalued by 1.64%, the fair value estimate of $62.99. Morningstar considers Mondelez a 3-star stock with a fair value of $63. As for my calculations, I found Mondelez to be undervalued by 6.15%, the fair value of $67.98. I do own a small portion of this stock in my Fidelity portfolio, and just like American Water's stock earlier, I'm not planning to add to the stock right now. Maybe if it falls by more than 10 or 15% from here, I'll have a relook at this. The next stock on our list is the Hershey Company, ticker symbol HSY. Hershey is from the consumer staple sector that manufactures and sells confectionery products worldwide. We know many of the Hershey's products like Kit Kat, Hershey's Kisses, Skinny Popcorn, Reese's Peanut Butter Cups, and so many others. Year to date, Hershey's has returned an impressive 19%. So when the overall market is down more than 15%, Hershey's has returned right opposite. The last 1 year, almost 29%. The last 5 years, a very impressive 117.6%. It has a market cap of $46.73 billion and currently yields 1.58% with a forward PE of 28.02. Recently, Hershey's announced a dividend raise of 15%. So, for all the shareholders of this company by August 18th, the dividends will be paid on September 15th. Historically speaking, Hershey's has been raising its dividends for the last 13 years at a 5-year growth rate of 7.83. So, the recent raise of 15% is almost double that of the 5-year average growth rate. It has a payout ratio of 44.38%. Tracker Dividends gives Hershey Company a dividend score of 81. It considers it overvalued by 5.11%, the fair value estimate of $216.32. Morningstar considers Hershey a 1-star stock with a fair value of $156. As to my calculations, I found Hershey to be overvalued by 23.6%, the fair value of $174.16. I do not own this stock in my portfolio, and at current very high valuations, I have no plan to add it also. The next stock on the list is Wells Fargo and Company, ticker symbol WFC. Wells Fargo is from the financial sector and provides banking and investment services. Year to date, Wells Fargo has fallen just over 14%. In the last 1 year, it has fallen almost 5%. Even in the last 5 years, it has returned a negative almost 19%. Wells Fargo has a market cap of $166.4 billion, currently yields 2.05% at a forward PE of 10.75. Recently, Wells Fargo had raised its dividend by a huge 20%. So, for all the shareholders of this company by August 4th, the dividends will be paid on September 1st. Historically speaking, Wells Fargo has been raising its dividend for just the last 1 year. It has a 5-year growth rate of actually negative almost 10%. When you look at the dividend history, when the pandemic hit in 2020, Wells Fargo had actually cut its dividends drastically from 51 cents a share to just 10 cents a share. We can see that even on this payout chart. So till 2020, Q2, it was paying 51 cents. From then on, the dividends took a massive hit. This payout ratio of 21.58%. Track your dividends gives Wells Fargo a dividend score of 60. It considers it overvalued by 4.6% with a fair value estimate of $41.85. Morningstar considers Wells Fargo a 4-star stock with a fair value of $58. As for my calculations, I found Wells Fargo to be undervalued by 13.7%, the fair value of $49.88. I do not own this stock in my portfolio, though it seems undervalued at the moment. I have many other quality financial stocks in my M1 Finance and Fidelity portfolio. The next stock on the list is Cintas Corporation, ticker symbol CTAS. Cintas is from the industrial sector and provides uniforms and other apparel services. Year to date, Cintas has almost been flat, returning just below 0%. The last 1 year, though, it has returned a positive 9%. Last 5 years, a very impressive 214%. It has a market cap of $43.05 billion and currently yields a very low 0.89% at a forward PE of 34.62. Recently, Cintas had announced a dividend raise of 21% and also announced an additional $1 billion stock buyback. For all the Cintas shareholders by August 12th, the dividend will be paid on September 15th. Historically, we don't see Cintas raising its dividends as per seeking alpha, but I don't think that is correct because if we see the historical payments till Jan of 2021, Cintas was raising its dividends annually, but since then it has been raising its dividends every quarter. Somewhere the calculation seems to be messed up. It has a 5-year dividend growth rate of 23.36%. So the recent 21% dividend raise is almost in line with its 5-year dividend growth rate. It has a payout ratio of 33.42%. Track your dividends gives Cintas a dividend score of 60 and considers it undervalued by just 0.3%, the fair value estimate of $426.84. Morningstar considers it as a one-star stock with a fair value of $284. As per my calculations, I actually found Cintas to be overvalued by 13.8%, the fair value of $366.77. Cintas is one such stock wherein the dividend yield may look very low, but the dividend growth rate is fantastic. So this low dividend yield, which may seem just below 1% right now, very quickly will catch up into a bigger number. But at current high valuations, I do not intend to look at this stock. The final stock on our list is Ford Motor Company, ticker symbol F. Ford is from the consumer discretionary sector that manufactures and sells automobiles worldwide. Year to date, this company has taken a real beating, falling almost 30%. The last 1 year, though, it has returned just over 10%. Last 5 years, it has returned 41%. Ford has a market cap of $59.06 billion and currently yields 2.04%. The forward PE of very low 7.41. Recently, Ford had announced a monster dividend raise of 50% for all the shareholders of this company by August 10th. The dividend will be paid by September 1st. Historically speaking, again, just like Wells Fargo earlier, Ford is seen to not grow its dividends recently because if when we look at the dividend history of this company, it had suspended its dividend when the pandemic hit, and that's the reason why we see a break in this particular dividend payment, which results in the streak being currently at 0 years. Likewise, the 5-year growth rate also took a big hit. But with all these recent monster dividend raises, I hope the growth rate will come into positive. It has a very low payout ratio of 16.39%. Tracking dividends gives Ford a dividend score of 41, considers it undervalued by 31.29%, fair value estimate of $21.38. Morningstar considers Ford a 5-star stock with a fair value of $24. As for my dividend calculations, I found Ford to be undervalued by 28.68%, the fair value of $18.90. Ford has been heavily investing into its electric vehicles, and as per the CEO, it plans to build 2 million electric vehicles by 2026. So, with its focus shifting from the traditional vehicles to electric, they currently already offer the Ford Mustang in an electric version. Also, plan to start the sale of the F-150 Lightning. I think Ford has a good chance to give Tesla a run for its money because there are many factors like battery production and other things, like ramping up the production to meet demand. It's not a joke. Tesla took almost 10 years to perfect it. So it will be a challenge for Ford to take on Tesla. These are the 10 stocks which we just saw. Of all these, I'm personally very impressed with Bank of America and Ford at current levels. I already have Bank of America in my portfolio and I'm very closely observing Ford. It's in my watch list for sure. And with its dividends restored to the pre-pandemic levels and a foreseeable growth in the future, I think I need to analyze Ford a bit more closely and take a firm decision. As we can see here, not every dividend growing company is currently correctly valued. You can see Kellogg's is slightly overvalued, Hershey's is very highly overvalued, Cintas is again overvalued. So hope this video has given you a good picture of what the current dividend raising companies are and where they stand valuation wise. Hope you found it valuable. I'd really appreciate if you could hit on that like and subscribe buttons so that YouTube can suggest this video to many more people out there. Until we meet in our next video, let's try to do as much as possible to be financially healthy. See ya.